This is Sean Mitchell. Welcome. We are live at the Flecha Azul podcast studio in Houston, Texas. This is Daniel Energy Partners in-basin observation podcast. I am very, very lucky today to be joined by my partner, Bob Stanton, and we are blessed to have one of our advisory board members at Daniel Energy, Loren Singletary. He's been around the industry a long, long time. And this week we're really it's part two, essentially. Last week we put out part one of takeaways from our Telluride event in late June. We had our keynote speaker, Mark Mills. That was part one. We actually released Mark Mills' presentation, which is actually fascinating. We'll hit a little bit of that as we start. But, the rest today we'll really focus on kind of takeaways in the industry from what we heard in Telluride from about 65 to 75 executives around the industry. And so with that, why don't we just kind of, Loren, I'll start with you maybe. Mark Mills, I thought was fascinating. I've never heard anyone talk about energy transition in that particular way. And I thought he made some really good points. I think some people would say it's hard to believe what he's talking about, but maybe just for the audience here, give us a little sense of what you heard from Mark Mills briefly.
Sure, Sean. One of the things I thought was very interesting is that the IEA goal for 2050 was to have 25% of our energy come from renewables. And that's an increase from today's current levels of about 14 to 19%. Well, in order to do that, wind and solar need to increase dramatically. I will just tell you that the world is getting bigger and more people, as far as population is concerned, more people. And, it's just not necessarily realistic that you're going to be able to get to those goals. Now, that was Mark Mills' opinion. But I thought one of the things, too, was that he talked about electric vehicles. 20 years from now, there's the hope that you'll have around 500 million electric vehicles in the world. And then we've got 10 million today. Well, that really, if you do have that, according to Mr. Mills, you only reduce oil consumption by 20%.
So that's 20 million barrels.
That's a lot. So,
but on today's metrics.
And today's world.
Metrics, yeah.
But with the increased population, the growing demand for energy from Southeast Asia, whether it's India, China, Indonesia, wherever it may be, some of these goals are very, very lofty, in my opinion, and also Mr. Mills' opinion.
I thought the comment that Mark made that I thought was really interesting was the amount of materials and minerals that all of a sudden we're just going to be digging out of places like China and places that are not really concerned about NIMBY, California type concerns.
Right.
These rare earth metals.
Well, and I think it was not just the amount of materials you have to dig up. I think one thing that caught my attention, I think, when he was presenting was, and no one really thinks about this, but you're basically, I think he said, you're going from a world where you're supplying energy with liquids and gases to solids.
Yeah,
right. That's
right,
what a transition to battery storage, to solar, to wind is, and because essentially on the batteries, you can't really supply the world with energy with solar and wind because the wind doesn't always blow and the sun doesn't always shine. So you need the battery storage component, right, to actually make that work. And so I think that, to me, when you think about how much earth you have to dig up, and you really are kind of going to a solids versus a gas or a liquid state of energy when you're using battery storage to actually make solar and wind work.
Yep.
And so for me, it was really, I think, I guess I knew that, but when he kind of said it, you kind of went, wow, he's right. This is gonna be a tough road to hoe. So
I think along those lines, one of the things that really struck me was the fact that some of the minerals and products, the solid products that you need to have to make these batteries, they're actually on a decline. You're talking about copper. You're talking about nickel.
No, that's right, Loren. I think that was one of the other key takeaways. I think of his presentation is that, when you think about batteries are going to get cheaper over time.
Yeah.
And what he basically said is, I've never seen a commodity with an increase in demand. I think it was 300 to 3,000% increase in demand.
Wow, good memory.
and the commodity price goes lower.
Goes lower.
And
Yeah, it was
so
crazy. And
so
it was scarce material.
I think when people start thinking about those types of things, it makes you think, man.
And he said all the IEA assumptions are based on price remaining flat.
Right.
Yeah.
And Bob, you just mentioned something very important: scarcity.
Scarcity.
Because when you have a product that's getting more scarce, you have to have larger mines to get the same amount of that product out of the low-hanging fruit's been had, basically.
Yeah.
Yeah.
I think we can just dig up California.
Yeah, there you go. That sounds good. Anyway, well, that's kind of a nice recap. And for those that are listening to this podcast, you can go back to last week's podcast and actually hear all of Mark Mill's presentation. And I think if you go online to the Manhattan Institute, you can actually access his slides as well. He's a fascinating speaker. In fact, he did the keynote speech this week at the Doug that I just got back from in Fort Worth. Yeah. So a lot of people walking around that event were talking about his presentation, and I think it caught some folks by surprise. And I think I had another board member of a company said we're having him come in and speak to our board. So I think he's really a fascinating guy to listen to. Is he going to be right? I think even if he's halfway right, it's going to be a challenge.
Well, I think when you think about halfway right, you think about what people like Tony Seba and people like that are saying, where they, and I should have mentioned this earlier, where they're talking about Moore's Law. And I thought he made a great point that Moore's Law is only good for information. And when he was talking about, decreasing the size of the semiconductor.
Right.
And how the goal was not necessarily to get smaller, it was to get more efficient. But everybody in the technology business knew it was possible and knew where it was headed. And there weren't very many skeptics.
Yeah, no, that's fair.
And that's not, he said that those the Moore's Law does not translate to energy.
Yeah, that's a good point. Well, let's move on to kind of what is going on in the industry. Again, I think having 65 to 75 company CFO, CEO types out in Telluride across the spectrum of E&P service, kind of a midstream. Let's go through some of these topics, because I think access to capital came up a number of times on a number of panels, and maybe Bobby will start over here with you on this topic. But just, I think we all know access to capital is tougher, but maybe give us some of the anecdotes from the conference that you thought were interesting in terms of access to capital.
Well, I think along those lines specifically, I think the private equity panel, both of our speakers were both very glad they weren't out raising new private equity funds, and that a lot of their traditional LPs are not participating the way they used to. They're not putting money to work in a lot of new management teams. They're currently kind of reinvesting money into their current portfolio. And I think the big thing is that they're having to run companies like companies and not drill up the corners and sell them off to the public like we used to. So now they're having to run a company for returns, return cash to LPs, and it's a different world.
Yeah, no, for sure.
And
Loren, what about you?
And if you look at the E&Ps that are in private equity hands, it really the quality of the asset matters. They're going to have to, as Bob just said, run these companies like real live oil and gas companies, exploration companies. And so the quality is going to matter, because you're going to have to continue to drill. And we can talk about this subject a little bit later on, but I think the private equity companies probably are going to be more inclined to continue to drill and increase drilling activity with today's commodity price, more so than the publics.
Well, and I think it's not just the public market that has decided to say, hey, we're not going to provide a bunch of capital here. I think it's not just the publicly traded companies, it's the private companies.
Yep.
I think the banks, the commercial banks, I talked to several folks when we were in Telluride. I talked to folks this week again at the Doug. Commercial banks are just not where they used to be. And when you talk about guys getting their, I actually had a meeting with a guy in Oklahoma City, and he said, our bank group has shrunk from 10 banks to 5 banks, and it was kind of hard to get the deal done, or just revolving, bank line to get done. And he thought it was crazy, given they were with a private equity sponsor they've been with for 10 years, so they had a proven track record. And he said you would be surprised how hard it was to get our deal done. And then further asked a guy this week at the Doug about this on the banking side that's a commercial banker, and just said, where are people in terms of price decks? Like, are the price decks going to move higher? Do you think these guys will get a higher borrowing base because of a higher price deck? And he said it's really not about the price deck anymore.
Mm-hmm.
He said it's more about cash flow. Right. So the banks have changed the metrics as well. I think that the entire industry has. That kind of leads into the next kind of topic here on M&A. We've heard a lot about M&A. Let's talk a little bit about some of the takeaways from the M&A market from Telluride.
Well, no, I was just going to say that the M&A market, I think you can divide it into two areas. Number one, the E&Ps, and then two, the oil field service companies. And it looks to me like obviously the E&Ps are trying very hard to combine where it makes sense, create synergies through less back office and administrative areas, but you're not seeing much premium, if any, paid for any of these M&A, any of this M&A activity as it relates to the E&Ps. And then if you go to the oil field service side, it's a little bit early in their cycle. You've still got way too much capacity out there, and how do you value that? You're not getting really paid for the quality of your say tier 1 type assets. So there's a lot of variables that go into this, and it's going to be interesting to see how it comes out in the future. But there was a lot of this discussion in Telluride, and I think there's still a lot of uncertainty.
I think so. And then the government, the PPP loans and the subsidizing of some of these companies that were not in good financial health to begin with has extended their lifeline, and so it's given them less incentive to do any kind of consolidation.
In fact, I think one of the panelists on the private equity side from the oilfield service side of the equation had mentioned that she thought some of the lack of M&A we've seen thus far is just for that reason, Bobby. That's a great point. I think the other thing on the M&A front that I thought was interesting is you're starting to see some new entrants in terms of capital, right? I think one of our panelists talked a little bit about folks like Vitol, folks like Elliott stepping in. It's just a different capital stream, and it's interesting on that front. Is had several conversations this week, and I think we heard some of this in Telluride, but I had several conversations this week at the Doug with guys about who's providing capital to these folks, especially on the oilfield service side. And I think there's several folks that we talked to that actually are getting capital from family offices, right? And I think that's amazing. I mean, it's just like that wedge of capital that wasn't there or even thinking about this space before now has kind of is showing up because they see, if you believe there's a cycle in front of us, it's actually an interesting opportunity. So let's talk a little bit about the different. I mean, we talked about M&A a little bit, but I also want to get into kind of the public versus private discussion because I think, as Loren, we talked a little bit before the podcast started. You mentioned, hey, the publics are going, the capital discipline route, and the privates are really the ones leading the charge. So maybe talk to us a little about what do we hear in Telluride on that front?
Because I think use a benchmark of say $60 a barrel. I think that you're going to see the publicly traded companies remain very disciplined, try to clean up their balance sheets as much as possible, and then where they can, return cash to shareholders. But it's all about the balance sheet. It's all about generating cash. Now, from the private side, $60 a barrel is very enticing. They will, in many cases, increase the number of rigs that they have running because they can generate cash that doesn't have to be. It can go back to the owners, and I think that there's more incentive for in this world for the privates to increase their levels of activity than it is the publics.
I just was going to, as far as the public side, we had the investor panel with a couple of public equity investors, and one of them from a big mutual fund, and I was surprised by his comment that portfolio managers they didn't care that it was dirty energy.
Right.
Yeah. They care about performance and they care about stock returns. And if one sector, if energy were to pick up steam the way it has so far this year, they feel like they need to be there. And I think, those guys get judged and incentivized based on their returns. And they're going to be there if that's where the returns are.
Exactly. And I gleaned the same thing from discussions with the investment community that were in Telluride.
Yeah. Well, and, when you think about the public versus private, I'll just add to, I 100% agree with your comment, Loren, on their absolutely disciplined, focused on returns, returning cash to shareholders. I think when you think about the reinvestment rate that these guys are talking about is kind of 60 to 65% reinvestment rate of cash flow. I thought it was interesting earlier this week in the Journal, or no, it was late last Friday in the Journal. Rick Muncrief from Devon basically said he's going to take his reinvestment ratio from 60 to 45%, given
the higher commodity.
Yeah, the higher commodity.
That's
price.
Interesting. Yeah.
And so that is interesting. It doesn't necessarily mean their budget won't go higher next year, but I do think with these guys, a lot of hedges rolling off. Right. A lot of these guys, you got to remember, these guys budgeted when crude was $40 to $45, right, for 21, and now, crude's at $75, and they're not all going to realize $75, but at the end of the day, let's just call it, to your point, 60 or higher versus a $45 price.
But let's just talk about your comment about 45% versus 75%, because I know we have talked internally about that commodity price. If you want to keep that reinvestment rate, great, but that's going to lead to more activity because you're going to have more cash.
Yeah, so what it really means, and what Rick Moncrief is saying, I had 5 rigs running, let's just use as an example, in 2021. Well, I'm going to have 5 rigs running in 22.
And that's different.
Well, and that is different. And on the private side, it is, they are still ramping. I mean, I think the anecdotes that we've picked up, John, myself, Bobby, the team has picked up. We were in Telluride 2 weeks ago. We were in Midland 3 weeks ago. We were in John was in Dallas, Fort Worth last week. I think the kind of current state of the market, the way we see it, we would see the rig count going up, especially in the Permian, another 75 rigs over the next 3 to 4 quarters. So I think a lot of that is still going to be private guys, and a lot of the anecdotes we're picking up on guys going from 2 to 4 or 4 to 8 rigs is on the private side. But look, I mean, if you're a private company and you're realizing $75 crude, oil field service costs are at the lowest point you've seen in probably a decade,
except for COVID.
It makes a lot of sense to do that. So
absolutely.
From that standpoint, I think that makes sense. I think, to your point, Loren, that the private guys are a much bigger piece of the rig count today than they were a year or two ago. Right. It used to be about a 40-60 split, I think, 40% private, 60% public, and I think we're getting almost the other way.
Flip now.
Yeah. I remember when the natural gas bubble in the early 2000s, it was privates dominating, and then that switched as the decade progressed.
Yeah. And I do think, Bobby, your point about, and I laugh because I sat through a lot of presentations at the Doug, and they kept talking about, dirty energy, and energy investors are not going to want to come back to this space. And I sat there and thought about the comment we heard in Telluride, because I agree with him. I think there's 2 things you kind of need for an investor to want to come to this space. And number 1, you need a commodity cycle. I think we have that. Number 2, you need returns. And you have to be profitable. And if the returns are there, I think it's always the guy that's not involved in energy, if he underperforms his neighbor because of that, that will change things. That'll change the mentality on investing.
Well, I think
energy.
also the word is returns, because back in the day, it wasn't returns, it was growth.
Exactly.
That's right.
And every single company got rewarded for growing.
Yep.
Didn't matter if you were service, didn't matter if you were E&P company.
Yep.
And that's how they were rewarded. And now that paradigm has shifted.
Yep.
And
for sure.
As the cash starts coming in and returns start coming in, as Jim Wickland pointed out, it's going to be an appealing space. I mean, there are going to be numbers that you can't ignore.
No, that's fair.
I mean, the amount of cash that Pioneer was talking about on their conference call was just astounding.
Well, I don't want to go here, but we're going to go here. We've got to hit the topic, ESG. How much did we hear about it in Telluride?
I think it's something that's very important, particularly to the publicly traded companies. ESG has been part of our dialogue for the last 5-6 years, and each year it becomes a bigger part of that dialogue. Historically, most of the investment community was really interested in the G piece of ESG.
Absolutely, yeah.
And now then it went to the E piece, and now it's the S piece. I mean,
Yeah.
we're covering all the bases. I don't think it's a check the box thing anymore. I think it's real, and I think it's something that we did talk about in almost every single panel that we had in Telluride, and there was a lot of, I thought, very good discussions about what companies are thinking about. In almost every one of those areas.
Right, and I think when you think about ESG, it's not only important for the environmental side and the social. Look, at the end of the day, I think Wickland may have said this in Telluride. ESG, it's access to capital, and it's a higher cost of capital if you're not there. Right. So if you're not ESG friendly, the cost of capital goes significantly higher.
Exactly.
And I thought he made that point well in Telluride, and I think I agree with him.
There was another part of that discussion that I thought was kind of interesting in that if you are, call it ESG compliant, and that's something you can hang your hat on as a service company, and you get involved with the bidding with other companies for an E&P company to do their work, and some of the other ones are not, and they're going to have a lower cost, are they still going to pick you just because you're ESG compliant? And I didn't hear any real concrete answers on that.
That's a great point, because I actually heard indirectly that they still were more interested in the cost of the goods and services.
I heard that after the panel.
Well, and I think I made the point, and I got shot down, but I think I made the point that who's checking, right? Who's making sure that they're following through.
Exactly.
It's kind of like the COVID test, right? You go get a COVID test. You got to have it to go to Europe, and when you land in Europe, nobody's checking. I just talked to a guy yesterday on my way home. I said, "Hey, how was your trip to London?" He said, "Well, we're supposed to quarantine for 10 days." And he's like, "Yeah, we kind of quarantined, but nobody's there at the airport checking you when you land. That, number one, you have a negative test, and number two, where are you going to stay for 10 days?" So it's not exactly the same, but it makes me think, this whole ESG thing it's real. And I think people need to do it.
There's no way it's not real.
I'm just wondering how it's going to get governed.
And I think that was a big point as well, especially the first day. We talked a lot about metrics and how nobody really has this. Everyone has different metrics. There's nothing standardized.
Right.
And so some people are focusing on methane emissions. Some people are focusing on, adding infrastructure. And, nobody's really got the same playbook.
Right. Well, let's move to another fun topic here. Let's get out of the ESG discussion, because I think, like you said, it's nauseating at times to continue to talk about it. Let's go North American activity and pricing. I mean, what were some of the takeaways from the conference that you thought were interesting in terms of where is activity going, what is happening to the pricing side? Let's kind of go through some of that.
Yeah, I really thought this was one of the most interesting pieces of the conference, in that from a service company standpoint, there's been a lot of new technologies that have been developed over the last 5, 6, 7 years.
Absolutely.
And the service companies in many cases really aren't getting rewarded for these new technologies. The way you're getting rewarded as a service company is that you get the job. And if you don't have these new technologies, then you don't get the job. But at some point in time, the oil field service companies need to be paid for their new products, their new developments that have made it possible for the oil companies, the E&P companies, to enhance increase the speed of drilling, enhance the recovery of hydrocarbons. And so that was, I thought, one of the interesting dynamics.
Lower the amount of people on a fleet.
Right, exactly.
There are lots of things that, a lot of these E&P companies talk about how low their break-evens are, and why are they so low?
Right.
Well, and I think that the other thing that I think we heard there when we were in Telluride, if I remember correctly, you guys might correct me here, but I thought I heard on the land drilling side we were starting to see some rates in the $2,000 to $4,000 a day higher range, which is great, I think. But the rig activity is up, and we're going to talk a little bit more about this. The rig activity is really up higher, significantly higher, and those rates are starting to move. But on the frac side, we're not necessarily seeing the same type of rate move or price increase, if you will, on frac. But I think from a drilling standpoint, it sounds like the drilling contractors are starting to see some movement. And Bobby, I don't know if it was you and John, but recently I think we've read on the well service side, guys have started asking for price and
Yes.
starting
Yep.
to get it. So
Yep.
it's not that pricing is not happening. It's just happening slow. And to
Slowly.
your point, Loren, I want
And
you
from
to
a
talk
very
about
low
something.
nadir.
Yeah, for sure. But what I want Loren to go back to, and he said it earlier before we started the podcast, was guys are not getting paid for the new technology. So let's talk a little bit about that new technology, because I think one of the things you want to talk about here is electric frac.
Sure.
Well,
Let's go back just for a second to the rigs. You talked about getting a few $1,000s a day more, but that is for the very top super high spec rigs.
That's right.
That's what you're getting
Yeah,
there.
I definitely said there's bifurcation.
And of course the increases are kind of ratcheted down the lower spec rig that you have. But that's also because you have a very, very high utilization rate of the super spec rigs.
Mm-hmm.
So let's keep it in perspective.
No, that's fair.
And back to the electric frac, or to high tier 4 frac fleets that have dual
DGB.
dual fuel
have
capability.
the
Yep.
dual capabilities for their energy, for their power. Are you really getting paid for that extra cost of those rig fleets? That's those frac fleets. That's really what we need to know.
Well, and I think today there's also a big discussion around how does the power? What's the power source, right? I mean, and I heard about that at the Doug as well. And I think when you think about some of the guys that were in Telluride, I think both VoltaGrid and Lifecycle Power were there, and those are the guys that are partnering with Halliburton and Nextier and those guys, because I think when you think about overall cost of fleet, right? So let's just assume, let's play with the numbers a little bit. Let's assume a normal frac fleet costs $30 million. Okay. Let's just use that as a starting point. And then the power is an additional $20 million, right? It's a $50 million price tag. And it's very, very difficult for a service company to pay for a $50 million fleet that he's basically getting the same revenue per stage, if you will, that he's getting from a Tier 4 DGB. Right. But what I would say is the industry at large, I think we are believers at Daniel Energy Partners that the industry is going to see a bifurcation in the frac fleet market. You're going to either be running E-fleets or Tier 4 DGB, and it's not just going to be the ESG question. I think it's going to be the fuel savings, the efficiency. I think it's going to be all the above, but I think that's where we're going to go. We're not there yet. I think we could go there soon enough, and we think that's where the industry's heading. And what I heard Tuesday morning at the Doug, ConocoPhillips did a presentation. 95% of their wells that will be fracked in 2021 will either be dual fuel or electric.
Yep.
Tier 4 DGB dual fuel or electric. So to me, that's amazing. I mean, that's a pretty good endorsement of what we're saying about where this industry is going.
Yeah, it was. The economics are really interesting, and the guys that I talked to about that, I think it was the VoltaGrid guys, if I'm allowed to say names, were saying that on their new e-fracs, that typically it's hooked up to the grid and the E&P pays for the power.
Yep.
Who knows how that works, and I guess everybody has something different. But it's not, pressure pumping capacity is definitely bifurcated now, just like the rig market.
Yep.
And it's not like it used to be where capacity, we have X capacity, and so it's going to have to be more specific, and I think different geographies are going to require different type fuels. I
agree with that, and I think in terms of, let's go back to one more kind of anecdote on the activity that we got from Telluride that I thought was interesting, and Loren, you were a part of the Thrive Energy Conference that we did in February at Minute Maid Park. One of the things I did at Thrive, all of our panelists, I asked the question, I'm setting the bogey at 500 land rigs by the end of this year. Every single one of my panelists emphatically chose the under. I said under 500 rigs by the end of this year. They all took the under.
Yeah.
I did the same thing in Telluride. I probably should have moved the number higher.
Yeah.
Because it seems like I got emphatically over.
Everybody said said under.
Pretty much everyone said, I'll take the over on 500 rigs. So what is it?
4 months.
Yeah,
4 months.
That's right. And where does that leave us in terms of where we think the rig count's going? I mean, I think I think if you look at our numbers and what our rig count forecast, I think we're at 551 by the first quarter of 22. But that's an average, a quarterly average. So the exit rate's probably higher, close to the 600 number that John and I and our team like to talk about.
Yeah.
We think you get to 600 rigs by the middle of 22. I think on the frac count, and by the way, 600 rigs by the middle of 22 is pretty strong. I mean, last Friday, the Baker Hughes rig count was 461.
Right.
Yeah.
You bottomed the first week of August of 20 at 231. You've basically gone up 100%. So it's pretty impressive what we've seen in terms of the rig count. The frac count, we think you're at kind of 215 active fleets today. That means the working fleet count is probably closer to 200. We see that getting up another 30 to 40 fleets by the middle of 22. So that's kind of where we see activity. And there are some folks out there that think we're at kind of 235 or 240 today. We can't get there. And then if you remember, several folks listing, if you pay attention to some of the bigger companies, Liberty, at their analyst day, basically said they think you'll be in the mid 250s by the end of the year. And, you know, we think that is implying 15 to 20 frac fleets out of Canada. So, you know, from a pricing, activity and pricing standpoint, we learned some great things in Telluride. Let's move on to one more topic, really, I want to hit before we close, and that's kind of labor, wages, competition, and poaching within the industry. Let's talk a little bit about some of the takeaways there. Maybe we'll start with you, Loren.
It's just become real obvious throughout the discussions at Telluride. Trucks, the truck drivers, whether it's a water truck, a frac tank truck, whatever it may be, there's a shortage of drivers.
Yeah.
And they're having to, the companies that have these services are having to pay up for that to get drivers, and they're stealing from they're poaching, as you would say, from other companies. And I guess my question is, as we just talk about that, is are they able to pass those increased costs along to the customer, to their customers?
Yeah.
Well, I think it's tough, and it's you're right. Trucking is a huge problem. I think we heard it on, I think Chevron said on their call they were losing drivers to UPS and Amazon. I think competition for people in general is really, really high. I think every restaurant in Houston has a sign in the window that says hiring. And then, you know, maybe go over to you, Bob.
I think they're still giving out checks in California.
Yeah, that's true.
I really do. I think I thought I read that the other day.
Yeah.
No, I mean, so, and then, you know, some real live examples that, as you know, our partner John loves to drive around the country and stop at Buc-ee's. You know, he actually showed us a picture that he took back in April, late April of this year.
2020?
No, of this year.
This year.
Late April this
That's
year.
right.
A cashier, this is just one example, a cashier at Buc-ee's was being offered $13 to $15 an hour in April, late April, okay? 3 weeks of vacation, 401k, and medical benefits.
Wow.
Okay? Fast forward to July 8, he stopped there last week. The same Buc-ee's, okay, so it's a fair comp, now are offering $15 to $19 an hour, 3 weeks of vacation, and what? It's a 20% increase at the midpoint in less than 3 months. And by the way, turning wrenches in West Texas on a rig in the heat and the what you would call not so safe environment, or you can sit behind the counter at Buc-ee's and make $22 an hour. I mean, the other thing, you know, an extra $2 an hour in the most recent posting at Buc-ee's if you'll work the night shift. That wasn't on the one in April. So to me, it's a really, really tough market. I did hear more at the Doug this week. I talked to lots of folks about labor, and labor's an issue. I mean, these folks are faced with some real problems.
Yeah. I've talked to a number of drilling contractors over the last, say, 30 days, and every drilling contractor's had to increase the rates for every hand that they actually have on the rig.
Yeah.
Well, and remember, whether it's Buc-ee's or working at a restaurant, you know, that guy gets to go home to his wife every night. Right. And the guy that's turning wrenches in West Texas has to stay in the man camp, or, you know, he's on 2 weeks on, 2 weeks off, whatever. Yeah. So I think that, you know what, that we think that continues to help you push pricing higher.
I thought it was interesting that one of our panelists mentioned that they were competing with they were trying to hire people for their oil service company, and they were competing with a car wash who was offering higher wages.
Yeah.
And they
That's
said
right.
they said that they needed to match. I think they had to beat that what the car wash was offering, and then they had to retroactively go back and give that same raise to all of their employees. So that's staying.
Inflation is real.
It is real.
Well, and I think that the tough thing is the current service pricing environment is not conducive to raising wages in the
That's the
oilfield
problem.
service
You're
sector.
raising wages, you're raising costs, but you're not getting any just so you can go to work.
Which,
and
by
you're
the
not
way,
getting paid for it.
Eventually, that's why pricing is going to move higher.
Coiled
It
spring.
has to.
It has to.
And I think the example that you brought up earlier about well servicing companies actually going to the customer whenever they have an inquiry and saying, this is the new rate.
Well, the crazy thing is John said, he asked this one guy, he said the first guy called in and he said, hey, we'll go up $10, and then the next call he went up $20, the next call he went up $30, and he got all three of them.
Right.
Yep.
So, I mean, and that's on an hourly rate. I mean, it is what it is, but I think sometimes just asking, and I had that conversation with a contract driller in Oklahoma City 3 weeks ago. He goes, I think some of our guys in the industry are just afraid to ask for pricing,
Mm-hmm.
and I think that's important. Bobby, one last thing. I think you brought up a great point before the podcast, and I think we ought to hit this. On the international side, we didn't have a ton of international discussions, but I thought the one discussion with one of our private service companies was very interesting, and maybe talk a little bit about that because it caught my attention.
Yeah, I don't think you would mind me mentioning his name, but it was Aaron Marquez, since he's Fletcher Azul, since we're in the studio.
Yeah.
Just talked about international business and that he's a small oil field service provider in Midland, and he preferred to do business internationally because of the long-term contracts that they were given and the source of security that gave employees and for him to do business over there.
Yeah, no, he was way more positive than I would have guessed for
Way
a
more
smaller
positive than I
company
would've thought, yeah.
than I would have thought on the international the market. So I thought that was interesting. Well, guys, really appreciate you coming in today. Loren, it's always a pleasure to have you. We love having you on the advisory board. Bob, you did a great job. Thank you for participating today. And then I want to just talk a little bit about our barbecue coming up September 30th in Midland. I'd be crazy not to talk about it. John would probably fire me if I don't mention it. But we've got 135 companies sponsoring, cooking, or judging in the barbecue already. So it's going to be a great event. And if you're interested in sponsoring or joining us in Midland September 30th, we'd love to have you. Go on our website and you can find a page for sponsorship opportunities. Thank you very much.
Thanks
you guys for joining us.
That was
Enjoyed
good.
it. Good job.